There was good news and bad in Friday's revised data about the UK economy. It grew marginally in the second quarter of the year, rather than shrinking as previously estimated. But the latest update from the Office for National Statistics also showed that the United Kingdom is the only G7 economy that has not recovered fully from the pandemic, with GDP still 0.2% smaller than at the start of 2020. And, according to the Bank of England, the economy is most likely already shrinking again, with inflation heading to 11%. The important thing, in Friday's data, was that the UK is struggling to grow and facing a probable deeper recession down the road, and today's revision doesn't change that, said Craig Erlam, senior market analyst at Oanda. Welcome to Savvy Economists. UK economy is once again on a tightrope, and it may be a long time before it does recover, given the crisis unleashed by Prime Minister Liz Truss's decision last week to unveil huge unfunded tax cuts alongside a massive package of energy subsidies. That gamble spooked financial markets and sent borrowing costs for the government, businesses, and households soaring. As we go into the video, make sure to hit the like button, subscribe, and turn on notifications. A weaker than expected recovery from the coronavirus pandemic has left the UK as the only G7 country with a smaller economy than in early 2020, according to official figures likely to further undermine the government's tax-cutting measures. Before the Prime Minister and Chancellor's meeting with the head of the government's independent forecaster on Friday morning, the Office for National Statistics, ONS, released figures showing that rather than the economy being 0.6% larger than in February 2020, a combination of a deeper recession during the pandemic and a weak recovery had left it 0.2% smaller. A better-than-expected performance in the second quarter of this year, overturning a previous estimate of a 0.1% fall to a 0.2% increase and reversing an assessment that the UK was in recession by June, was not enough to boost GDP growth sufficiently to recover from the first lockdowns in 2020 that brought large parts of the economy to a standstill. Analysts said Richard Hughes, the head of the Treasury's independent forecaster, the Office for Budget Responsibility, would be forced by the new figures to take a tough stance on assessing the impact of further borrowing on the public finances. All the other major economies in the G7, including France and Italy, recovered strongly enough to be larger than they were in February 2020. Despite the better news on the performance of the economy in the second quarter, the overall picture is that the economy is in worse shape than we previously thought, Paul Dales, an economist at Capital Economics, said. And that's before the full drag from the surge in inflation and leap in borrowing costs have been felt. The Bank of England said earlier this month that it understood the UK economy was already in recession after it forecast a fall in GDP of 0.1% in the third quarter, leading to 2 consecutive quarters of negative growth. But the ONS estimate of growth in the second quarter shows that while the economy is depressed, it is unlikely to enter a recession until the end of the year. Separate data showed house prices failed to rise month on month for the first time since July 2021, the latest sign of the slowdown in the market caused by the cost of living squeeze and rising interest rates. Kwasi Kwarteng published an economic plan on Friday last week that he said would spur growth by cutting taxes. However, investors responded to the mini-budget by selling the pound and offloading British government bonds, increasing the interest bill paid by the Treasury. Samuel Toombs, the chief UK economist at Pantheon Macroeconomics, said the figures suggested that the damage inflicted by COVID-19 and Brexit onto the economy's ability to grow was even larger than previously thought. These revisions will compel the OBR to revise down further its estimates for future potential GDP, he said. The recent turmoil in British financial markets has also highlighted the UK's large current account deficit. The amount by which the value of imports exceeds that of exports has worsened since the financial crisis of 2008 and the Brexit vote, despite steep falls in the value of the pound that make exports cheaper. ONS data showed the current account gap in the April-June period shrank to £33.8 billion, or 5.5% from a £43.9 billion deficit in the first quarter, which was revised down from an earlier estimate. However, the January-March deficit remained the biggest on record, the ONS said, revealing the difficulties UK exporters are having finding markets for their products and services. Eurozone unemployment came in at 6.6% in August, unchanged from July and showing evidence that the labor market has remained resilient despite the impending recession and energy crisis sweeping the continent. With labor markets still tight and inflation gradually becoming more entrenched in the euro area economy, today's numbers will only embolden the ECB to focus solely on inflation, giving them a green light to introduce another sizable policy rate hike even as the economy rushes headlong into a tough winter and recession, Shah said. The euro area faces a particular dilemma. Not only is containing inflation largely out of the ECB's reach due to its supply-side foundations, but raising policy rates will only deepen the acute economic weakness which is beginning to engulf the region. Eurozone inflation hit a new record high of 10% in September, Eurostat data showed on Friday, up from 9.1% in August and above consensus projections of 9.7%. The reading also showed price increases broadening out from volatile food and energy prices into nearly all segments of the 19-member bloc's economy. Energy prices rose 40.8% year-on-year, up from 38.6% in August, followed by food, alcohol, and tobacco at 11.8%, up from 10.6% last month. However, core inflation, which excludes food and energy, climbed 4.8% over the year, up from 4.3% in August, and economists broadly expect the situation to get worse before it gets better. Friday's print will exert more pressure on the European Central Bank to hike interest rates aggressively at its October meeting and increases the likelihood of a longer and deeper recession across the Eurozone. Seema Shah, the chief global strategist at Principal Global Investors, said that while headline inflation may be at its peak, the continent's situation remains deeply concerning. Indeed, while headline inflation may start to ease as a result of base effects and volatile energy prices, with the unemployment rate itself at a new low, core inflation is building momentum and is likely to rise further in the coming months, she said in an email Friday. What happens next is far from clear. Truss and her finance minister Kwasi Kwarteng insisted Thursday that they would stick with their plan, but they have a very narrow window, perhaps as little as 2 weeks, to convince investors that they can be trusted with the nation's finances. The Bank of England's emergency bond buying is due to end on October 14th. The OBR provides an independent assessment of the impact of government budgets on borrowing and growth. Truss and Kwarteng had rejected its offer to provide a draft analysis of last Friday's fiscal bombshell. Mel Stride, a senior lawmaker from Truss' Conservative Party, said that the OBR was likely to deliver a very uncomfortable message on Friday. I suspect strongly that it will be that this circle cannot be squared, Stride told the BBC. Promising large unfunded tax cuts with inflation running high and a tight labor market, and expecting reforms to generate the growth to pay for them would not work. So there needs to be a rethink, and that will be a very difficult conversation, Stride said. The OBR said after the meeting that it will deliver its initial forecasts to Kwarteng on October 7th. The Treasury said that it would publish the forecast alongside its medium-term fiscal plan on November 23rd, resisting calls from lawmakers to release them as soon as possible. The big problem for the UK government is that it is caught between having to reassure the markets and voters who are growing increasingly angry at the spiraling costs of their mortgages. Raising, postponing, or abandoning tax cuts will be avoided by Truss at all costs, as such a reversal would be humiliating and could leave her looking like a lame duck prime minister, wrote Mujtaba Rahman and Jens Larsen at political risk consultancy Eurasia Group earlier this week. The only alternative left to balance the books would be to slash government spending, and that would prove equally politically difficult as a recession looms with its public services under enormous strain and a restive workforce that has shown it's ready to strike in large numbers over pay. Poll ratings for the Conservative Party have collapsed. British polling agency Survation recorded its largest ever lead for the opposition Labour Party over the governing Conservatives this week, 21 points. The poll, taken September 28th to 29th, found 49% of respondents said they would vote Labour if an election were held tomorrow, up 6 points from their showing on September 5th, the day before Truss took office. The Conservative Party was on 28%, down 5 points. A separate poll by Ipsos UK, also released on September 29th, showed Labour with clear leads over the Conservatives on policies for the economy, managing taxes and public spending, and the cost of living crisis. Having spent the summer bashing economic orthodoxy and, in the words of former central bank Governor Mark Carney, undermining some of the most important UK institutions, Truss and Kwarteng met Friday with one of those key players, the Office of Budget Responsibility. The UK is already in the throes of a full-year recession, according to S&P Global Ratings, while Europe faces a tough winter and rising credit risk. In a report published Tuesday, the rating agency projected that Eurozone growth will stall in the fourth quarter of 2022 and the first quarter of 2023, with growth for the year only reaching 0.3%. Europe faces a difficult and uncertain geopolitical and economic outlook as Russia's political risk appetite appears to increase after losses of territory in Ukraine, and exorbitant energy prices fuel inflation, triggering interventions to support consumers and businesses, with central banks recalibrating interest levels in quick order, S&P said. It also predicted that the UK is already in the midst of a moderate four-quarter recession that started in the second quarter, as households face inflation running at 9.9% and expected to rise further over the winter, quashing consumer spending over the coming quarters. Fiscal support measures deployed by the government, notably the upper limit set on typical household energy bills, energy price guarantee, will significantly protect household budgets from an even greater inflation squeeze over the winter, S&P Regional Credit Conditions Chair Paul Waters said in the report. However, Waters noted that inflationary pressures are not confined to retail energy prices, and the plunging pound will further drive up the price of imported goods while domestic price pressures remain elevated, with core inflation, excluding volatile food, energy, alcohol, and tobacco prices, still above 6%. S&P expects the Bank of England to respond by raising interest rates from the current 2.25% to 3.25% by February 2023, sharply cooling the economy to return inflation toward its 2% target in the medium term. Beyond global and regional risks related to the Russia-Ukraine conflict, lasting or deepening volatility in the pound's exchange rate and gilt markets could lead to more adverse financing conditions and worsen the broader economic environment beyond what we currently expect in our forecast, Waters added. The pound hit an all-time low against the dollar on Monday, while UK gilt yields have surged as markets recoiled after the new government's controversial so-called mini-budget on Friday. The suite of policy measures included tax cuts and energy subsidies to households and businesses estimated to cost a minimum of 9% of GDP through 2026, and the Bank of England responded by reiterating its commitment to further monetary policy tightening to rein in sky-high inflation. The concern for the gilts market is that nearly all of that 6% of GDP will be funded via new debt, during a period when the BOE is shrinking its balance sheet and sterling depreciation is adding to inflationary pressures, the S&P report added. Finance Minister Kwasi Kwarteng's tax cut policies have drawn criticism from U.S. Federal Reserve official Raphael Bostic and former Treasury Secretary Larry Summers, while the International Monetary Fund issued a rare public rebuke late Tuesday. S&P is forecasting annual UK GDP growth of 3.3% in 2022 before a contraction of 0.4% in 2023. An emergency intervention by the Bank of England on Wednesday calmed markets and prevented the collapse of some pensions funds. But the trust plan to boost growth has backfired badly, with investors now expecting that the central bank will have to raise interest rates by 1.25% or even 1.5% by November to tackle its inflationary impact. Does the UK still have any trump card to pull and get out of this mess? Will Liz Truss be able to take on the pressure of running an already almost collapsed economy? Let us know what you think in the comment section below. Don't forget to like, subscribe, and turn on notifications. Thanks for watching.